You've seen the screenshots, traders turning a few $1,000s into six figures. But here's the twist. Most of those pros aren't gambling on lotto calls or YOLO weeklies. They're using a boring, structured, repeatable setup that quietly compounds. In this video, we'll pull back the curtain on the real $0 to $100,000 option strategy the pros use and why they almost never talk about it publicly. The myth of the home run. When people think about big trading wins, they picture that one lucky 10 times call option that hit right before earnings. But professional options traders don't build wealth off luck. They build it off consistency. The truth is, most long-term pros are option premium sellers. They make money from the one thing that never stops: time decay. Instead of trying to predict direction, they sell overpriced options again and again, harvesting small, consistent gains that add up over time. The real strategy: systematic credit spreads. The strategy that quietly turns small accounts into big ones is a systematic short premium approach, usually built on credit spreads or iron condors. Here's how it works. Sell out of the money put spreads and call spreads on high liquidity tickers like SPY or QQQ. Target 30 to 45 days to expiration. Aim to collect about one-third the width of the spread as credit, say $1 on a $3 wide spread. Manage winners early. Close once you've captured 50 to 60% of the credit. You're playing the odds, not guessing direction. With hundreds of occurrences, the edge in theta and IV decay compounds into real equity growth. Why it works and why pros hide it. So why don't the pros brag about this? Because it's not sexy. Selling premium doesn't look like gambling glory. It looks like collecting rent. But here's why it works. You're the house. Options decay in your favor. You get paid up front, credit in your account from day one. Probability advantage. Most short spreads win 60 to 70% of the time. Compounding effect, small steady profits snowball. A disciplined trader managing 5 to 10 spreads a month can slowly grow a small account while controlling risk, the opposite of chasing home runs. The real math, how it scales. Let's run quick numbers. Start with $5,000. Sell $3 wide spreads, collecting $1 credit. Risk is $200 per spread. You can run 5 spreads, which is $1,000 total risk, $500 potential credit. Win 70% of the time. Close early at 60% profit. That's roughly $210 per month average gain. About 4% on account. Compound that monthly for a few years with good discipline. You're in the six-figure zone. It's not magic, it's mechanics. The catch: risk, management, and discipline. The secret isn't the setup, it's the management. You must cut losers fast, 2 times credit rule. Never double down on revenge trades. Stay mechanical, no emotional overrides. Selling premium prints, money, until it doesn't. Without rules, a black swan move can wipe you out. With rules, it's one of the most scalable, consistent edges in options trading. To recap, the real $0 to $100,000 strategy isn't gambling. It's systematic short premium trading. It compounds small wins through time decay, probability, and discipline. Manage winners, cut losers. Repeat. That's the pro's quiet formula. It's not flashy, but it works. And now you know why most pros won't admit it. Thanks for joining us at optionstrading.org. If this breakdown helped you, hit like, subscribe for more advanced trading insights, and comment below. Do you think you could stick with a boring system long enough to let it work?